Hey everyone, this is John White here with you. It's good to be with you all here today. I'm going to just take a few minutes and go through some examples of the kind of trading that I'll be teaching about on September 27th down in Atlanta, Georgia. For those of you that don't know, I will be doing a class in Atlanta at the BetterTrades headquarters on September 27th. I'll be doing a full one-day class, and the name of the class is called Spreading Out, because what I do with most of my trading is I trade spreads, buy spreads, sell spreads, and I trade these things in all different fashions. So let's take a look at this particular example. This is an example we had on as a practice trade for the month of September. And if you look right here where you see this blue arrow, that's July the 30th, and that's the day we entered this on. And what we did here is we basically sold two credit spreads, a bear call spread up top and a bull put spread at the bottom. And let's look at the bull put spread first. See that 10-20 area? We sold a 10-20 strike put option. We sold 10 contracts of that for maybe, let's say, $1, right? Let's say we sold those options for $1. And then we bought 10 contracts for insurance to limit our downside risk. We bought 10 contracts of a September 10 put option, which is this one right here. And let's say we bought those for 40 cents. So if we sell to open the 10-20 put for $1 and we buy to open the 10-10 put for 40 cents, that creates a credit of 60 cents. That means we're paid a 60-cent credit to enter this trade. So that credit is sort of put into our account right up front. And for this put spread that we sold, this is a bull put spread, in case you're wondering. That's the technical name of it. So this bull put spread, for this thing to be fully profitable, the market needs to stay somewhere above the green line, somewhere above 1020. It doesn't really matter to me whether the market goes down or up or sideways in the next few weeks. As long as it stays above that 1020 area, that put spread is going to expire worthless, and I'm going to keep that 60 cents credit that I sold the spread for on July the 30th. Now, if you look up here at the top of the chart, you see here that we sold to open a 1240 strike call option, 10 contracts, and let's say we sold those for $1.50, and then we also bought 10 contracts of the 1250 call option, maybe for $1. So if we sell a 1240 call for $1.50 and we pay $1 to buy the 1250 call option, that's a 50-cent credit that we're paid as soon as we enter this trade. So again, we're being paid a credit to put these two positions on. And on this call spread, this is a bear call spread that you see here at the top of the chart. When we sold this bear call spread for 50 cents credit, what we really want to happen here is for the market to simply stay below that 1240 green line, excuse me. As long as the market stays below that 1240 green line, that call spread that we sold will expire worthless on expiration day, and we'll get to keep that 50-cent credit that we got paid to get into this trade. So what we're shooting for here, if you add up the credits, 60 cents plus 50 cents, that's $1.10. So basically what we're looking at, if you base this on risk, we are looking at making about a 12% return in about a month. That's what we're planning on for this trade, is about a month, and we're going for about a 12% return on this. So what I want to do is I just want to fast forward here day by day and show you what the market did. It went down quite a bit the very next day after we got in, down the following day, a little bit of sideways movement, still going sideways, not really going anywhere huge. Get a little bit of a bump up, down again, and now we're trying to go back up. And I'm not really trying to analyze each individual candle here. I'm not really concerned with where the market goes on a daily basis, on an intraday basis, or even on a day-to-day basis. All I really am concerned with is that the market stays below 1240 and above 1020. Excuse me, above 1020 but below 1240. And as you can see, even though the market has gone down and it's gone up and it's gone up and down, and it's done lots of different things, we are very comfortably staying between those levels, right? So we're not sweating this trade out. We're not really concerned about this. This isn't something that is requiring a lot of attention or a lot of babysitting out of us. This trade really doesn't need a lot of help from us, because what's happening, we sold these trades for $1.10 total credit. That $1.10 is really burning away. It's decaying, so that's money coming to us, right? This is a trade where we're actually being paid to sit and hold this thing as those options lose their time value, as they decay as we approach expiration day. And as we keep going forward here, the market kept going up, and as you can see, starts to drop off a little bit more. And let's go all the way up until present day, which is the 2nd of September. And you can see the market is right here at 1179.47. And right now, with the market sitting where it is, we've been in this trade about a month. And so far, what we have on this trade, because both of these spreads have lost so much value, they've decayed so much as we're approaching expiration, that we have about a 10% return in about a month of trading. All right, folks. So don't turn that away. That's a very nice return for about a month on this practice position that we have on here. Okay, very, very nice. Now, something I'll just touch on briefly is a lot of you are probably wondering, well, what if the market did go really, really high quickly? What if it went, up close to 1240 and we wanted to shut down this bear call spread up here? Or something that a lot of you might be a little more fearful of is what if the market really came down quickly and started to approach this bull put spread down here? What would we do then? Because we would need to close out that bull put spread before the market got too close to save ourselves from taking a loss on this trade, or at least try to minimize the loss, right? We would want to close that out early. Well, the good thing here is that we've taken in a $1.10 credit on a 10 contract example, which is what we're trading here on this practice trade. That's $1,100. So if the market starts to go too high or too low and we feel threatened on the call spread up top or on the put spread at the bottom, what we can do is we can use a portion of that $1,100 and we can play defense with that, right? The market paid us $1,100 to get into the trade, and that $1,100 is ours to do with as we please. So if the market started going down too far, I could take a portion of that $1,100, maybe $500, $600, $700 of that $1,100, and I can buy some protection to protect and defend this put spread. Same thing on the upside. If the market started going up too far, I could take a portion of that $1,100 credit and I could play defense and defend this guy up here. All right, and these are a lot of the details that we'll be going over in that one-day spreading out class there in Atlanta on September the 27th. So, folks, this is just a quick preview of some of the things we'll be covering. There's a lot more to come on this kind of trading, and we're going to get into a lot of combos and mixing and matching and different things we can do with buying and selling spreads and doing so in different combinations. But I just wanted to try to give you guys a really good preview of what will be coming up in that Atlanta class. Also, I do want to mention, although the one-day spreading out class is on September the 27th, Rob Roy and I will be doing a next step class together Thursday and Friday, the previous 2 days, the 25th and 26th of September. So if you decide to come to that one-day spreading out class and spend the day with me there and learn this kind of trading that I do, you can also attend that 2-day next step class for free. So basically you can come to the full 3 days, the 2 days with Rob and I at Next Step, and then the one-day spreading out class with me, where we'll be covering a lot of the types of trading we're looking at here in this example. All right. So, folks, I look forward to seeing you all in Atlanta, Georgia. I'll see you then. Everyone have a great day. Bye-bye.